This is Matt Graham with the MBS Live Market Update. Last week was a bit of a placeholder, a bit of a consolidation after the previous week saw a colossal rally on Wednesday through Friday, culminating in the big jobs report. Coming out of the jobs report, there really wasn't much on the economic calendar, this is referring to last week, that would stand a chance to be remotely as big of a market mover. So we focused on the next best thing. We looked for whatever might be on the calendar that could have an impact. That included largely the Treasury auction process, and it was arguably more interesting than normal because it was a refunding auction cycle, and that means that once a quarter, Treasury issues new coupons for each of the securities that are on the auction cycle, and those see a little bit different bidding and buying statistics relative to the reopening auctions that come out in the subsequent 2 months. This was also the first round of the newly increased auction amounts, and it was thought that this could provide some sort of gauge of investor demand for the higher amounts. But in my opinion, I think it would have more to do with gauging investor demand for the recent drop in yields, considering 10-year Treasury yields were pretty close to 4% a week before at the beginning of the previous week, and then, down at 4.5% for auction week. The 3-year and the 10-year auction went fairly well. The 30-year auction on Thursday completely tanked, pushed yields back up. But when we looked back over the course of the week, the entire week's trading range was contained by the previous Friday's trading range. So sometimes in the bond market, you get what's called an inside day, meaning that the highs and the lows of the current day fall inside the highs and the lows of the previous trading day. And that speaks to consolidation, indecision, and perhaps staging for an upcoming move, if you want to take it, a step further. But in this case, I really think it speaks to consolidation, as the next big shoe to drop would be tomorrow's CPI report. And so that brings us to the present week. CPI is the big to-do. Comes out tomorrow morning, 8:30 a.m. It's expected to be at 0.3 month over month in terms of the core yet again. And that would bring the year-over-year core to 4.1%. Actually, that's where it was previously, so it would keep it there. Headline is expected to fall to 3.3 from 3.7, and month-over-month headline is expected to fall to 0.1 versus 0.4. Headline inflation includes food and energy prices, and there's been some disinflation there in the month of October. But market focuses more on the core. As far as bond trading levels, we're starting the week near the highs of last week. We poked just barely higher than that in early trading, but are back down below now. The tone in the remainder of the week likely to be set primarily by CPI, assuming CPI comes in somewhat far from forecast. If it's right on the screws, it's hard to say what the impact would be. Then retail sales in the following day on Wednesday morning, also a potential market mover, not quite on par with CPI, but a big swing expected from last month's very high 0.7 gain. Now we're looking for minus 0.3, so that leaves quite a bit of room for the actual result to come in far from forecast and put a little bit of spin on the ball this week as far as trading levels are concerned. Other than that, Fed speakers and the bond market simply trying to feel out whether there's going to be more of a consolidation here around 4.5%, whether we're going to bounce back up toward 5%, or whether we're going to make progress down into the lower 4% range. Neither the Fed nor the average bond trader wants things to move too quickly, and I think we saw some pushback against that notion from the Fed in speeches last week, especially from Powell himself. And that stands to reason, considering we tend to see the Fed sort of push back on whatever direction the market's been moving if it has been moving faster than the Fed thinks it should. All of these things good for financial stability and predictability, and making comments on the level of rates and their implications for the level of accommodation coming from monetary policy. In other words, if it's too big of a moving target, it's harder for the Fed to do its job. And the Fed also concludes that the market can do a better job of pricing to perfection if things aren't moving quite so quickly. That could mean that the Fed remains a little bit more hawkish the closer we are to 4.5%, but ultimately it will continue to be driven by data. So if CPI were to come in close to 0%, which would be a very big miss, then we would certainly expect 4.5% to get crushed fairly quickly and for rates to move lower and for the Fed to be okay with it. Conversely, if CPI were to come in at 0.4, 0.5, 0.6, now rates are very likely spiking back up toward 5%, not necessarily in a day, but that data would go a long way toward pushing us in that direction. That's going to do it for this week. Back to you.